very short version of who we are as public, right, is we're an investing app focused on helping sort of, retail investors, initially in the US and now globally, be better investors. I think we always look at like, hey, where is there something that we want to be able to do that we can't in the form factor that we want? So, I think my decision to join the military was similar to a lot of other folks, right? I think it came out of a sense of duty. Instead of having to go and scroll through the app, go to the Apple page and look through the news and so on, we've now used the GPT-4 to build Alpha, which is a chat-based interface for finding that same information.
Welcome to this edition of the Raz Report. This is what I call the Fintech Power Hour. We have a Fintech powerhouse on today, and that's what we're doing. So we got this public, the brokerage, Steven Sikes. He's the CEO of the brokerage part of the business. What up, Steven?
How's it going? Glad to be here. Thanks for having me.
So do you go by Steven, Steve? What is it? Always Steven? Just you tell me.
Yeah, it's professionally, it's been Steven ever since I got out of the Army, but I grew up sort of an athlete and then in the Army, so I was always Sikes. And so, it's like I have two halves of my life. The first half of my life, everyone knew me as Sikes, and the professional half of my life, I'm now Steven.
And you're a PH, not a V.
Indeed.
Yeah. See, why do they Steve? Yeah. See, I don't know, because Jason, some people spell it with Jayson. I don't know. This whole name nomenclature of names is very interesting. So how long have you been at Public for?
Coming up on 3 years. So, not quite the day of founding, but we were still a pretty young company, about a little less than a year in market, as I joined about 3 years ago. So it's, we've been in market about 4 years. So still from the early days, mid COVID, but pre GameStop, we like to say.
Did you come in the role that you're now, or did that change over time?
Yeah, so I joined in the same role. So I joined as the COO of sort of the overall enterprise, and then as the CEO of the broker dealer, which, technically I took over the role as CEO of the broker dealer following a, sort of formal changeover on the broker dealer and all the regulatory filings and stuff. But that was sort of the plan from the day I started.
And the changeover from the broker dealer was from T3 to your guys' own broker dealer?
No, it's been our broker dealer the whole time, but Sean Hendelman, who leads T3, was the CEO before I was.
Got it. Okay, very nice. Okay, so now Public. Well, there's so much I can get into. We know the two other guys operating it. You guys I've seen be the most innovative with things, experiences, trying to create engagement for the audience. We're going to go into some of those experiences in a minute, but how often do your users open the app? Like, how do they come to open the app? Is it through emails? Like, how is the engagement there?
Yeah, so I think first off, maybe for the audience's benefit, I hope everyone knows who we are, but the very short version of who we are as Public, right, is we're an investing app focused on helping sort of, retail investors, initially in the US and now globally, be better investors. And I think there are like two big prongs of that strategy. There's a lot of stuff we can do to help people be better investors, but the two prongs are one, really giving people the broadest access to assets that they can invest in, right? So it's everything from stocks and ETFs to, sort of treasury bills on the other end of the spectrum. And I think, that sort of strategy has really helped us in the last year and a half as sort of the markets have become a little more volatile. The second part is just making sure they have access to the best possible content and information and data, research, analysis, and all that great stuff, which obviously we work pretty closely with Benzinga on, and making sure that people can stay up to date on what's going on in the markets and have everything they need to make the best decisions they can for themselves. And so going back to your question, right, like how often do people come back? I think people come back for two reasons. One, they come back, to invest, right, and to make an investment, to make a trade, to buy some T-bills, et cetera, to manage their portfolio. Or they come back to keep up with what's going on in the markets. Both, hey, the markets overall, the macro picture, also, what's going on in their watch list, and then what's going on exactly in their portfolio. And so I think because we have that sort of two-pronged focus, and because we have spent so much time and effort on, delivering really great content in the app, we see a lot of engagement. And I think, through what's been an interesting cycle over the last, like I said, 18 months, 2 years, we have maintained really high sort of active user counts because I think we've focused so much on the information and content side of the investing experience.
Yeah, and I kind of feel like you created the app to create the app for yourself, for what you would want to see or what people would want to see. Like that. Like I feel like it's one of those experiences that, hey, why doesn't this brokerage have this? And you guys keep going, keep going down that path. Is that accurate?
Totally. And I think when we look at like as users, right, we're all like, we're all frequent users of public, but we also use all of our competitors' apps. It sort of comes with the territory, right? I think we always look at like, hey, where is there something that we want to be able to do that we can't in the form factor that we want, right? Like I think we sort of differentiate versus some of the old discount brokers and legacy brokers by being app and mobile first, right? And I think we all recognize in 2023, like if you're not here, if you're not pointing to the phone, I'm pointing to my phone and holding it up for those of you listening only, great podcast content there. If you're not on the phone and you're not on mobile, right, you're not relevant, right? And you're going to sort of constrain the places where people can interact with you. And so we want to make sure that we have the full suite of capabilities for investing that we can. And so like, when I go on my Schwab account or Fidelity account or so on, there are incredible companies, incredible platforms that give an incredible breadth of investment options. But if you go into their mobile apps, you can only do a little fraction of what that is, and it's usually pretty clunky and kind of hard to figure out what's what. So we work really hard on taking sort of the full spectrum of investable assets, and are in the process of bringing them down into a consumable form, in a consumable mobile first form.
And I want to go back to the app, but before I do, again, we're with Steven Sikes. We're on the Raz Report Fintech Power Hour. He's the COO and CEO of the brokerage part of public.com. But prior to that, you have an interesting background. You joined the Army. What made you join the Army? Is it something passed down through generations, or in how long were you in the Army for? So we're gonna do a little more back, a little more personal profile. Then we'll get back to public and the fintech stuff that we have going on, and we'll talk about our fintech deal day in New York, et cetera, et cetera.
Yeah, sure. So, I think my decision to join the military was similar to a lot of other folks, right? I think it came out of a sense of duty, and I did have a family history on both of my grandfathers had served. One grandfather during World War II, and the other during Korea, and so I'd sort of grown up with that, just by virtue of them setting the example, and had always sort of known that was a thing I wanted to do. And then when I went to college, I had the opportunity to get an ROTC scholarship, and said, okay,
where'd you go to college?
I went to Georgetown, so
okay.
Hoya Saxa for all the Hoyas listening out there. But so I got an opportunity to get a scholarship to join the ROTC program, and they were going to pay for school. And I knew, sort of as I looked at myself and sort of knew what I needed and wanted out of my career, I realized there was both an opportunity for professional development in terms of building my own sort of discipline and leadership challenge, and then or leadership skills. And then the second is I recognized an opportunity to sort of give back. And I think that was the unique way that I thought I was best suited to sort of, give back to the country that gave me such great opportunities.
Awesome. Are there things you use from the Army today, that you learned from the Army?
Every day. I think the thing that comes up most frequently, interestingly, is just weird to say, but a calmness under fire, right? I think, we deal in sort of the financial markets, and there's always something crazy going on, some crisis. And, I think in many other contexts and other folks that I've been around tend to get a little more turned up in things that, go bad or go wrong. And I think when you've been in the service, you've served in combat, I think you look at sort of things that can happen in the civilian life, and you're sort of like, okay, well, it's all going to be okay, right? Nobody's shooting at us today. So, the market could rally, the market could take, it's all going to be all right.
That's awesome. But I want to go a little more deeper on that. In the Army, it's very ritualized, right? Wake up, breakfast this time, make bed this time, 5 a.m., 6 a.m. Has that carried through to you, and like how you structure your days, be it an on day of work or an off day on the weekend?
No, I don't think it has, to be honest, right? I think I wake up early. I think that's me more than.
What time do you get up at?
So I'm up between 5:30 and 6. So not the earliest riser in sort of the capital markets world, but early enough.
No, that's early.
I'm the first. I try to be the first guy in the office here, and I think so that's sort of stuck with me. But I'm not a particularly ritualized, structured calendar person, because I think in my day-to-day job, My role is actually to be a bit of added capacity to solve problems as they come up, right? I, as much as possible, want to make sure my team sort of has the day-to-day covered and has the sort of near-term and mid-term projects all covered, everything that we need to get done. I want to make sure that they're there doing that, and my job becomes, to plug holes and to help make them better on a daily basis. So I try to actually preserve a lot of flexibility in how I spend my time, because my job has the privilege of being able to sort of float into things that are the highest leverage on a given day.
Right, absolutely, and that's important. Anything else from like your growing up days, Georgetown, growing up, elementary school, that like carried through to you for what you do now and the role that you're in?
Yeah, I think I was really lucky as a teenager. I remember my mom and dad sitting down with me in front of the computer to actually invest in my first mutual funds, right? So we were USAA members by virtue of my grandfather, and we went into the clunky mutual fund experience. And I still remembered I was probably 14 or 15 and buying my first mutual funds into that account there, like the custodial account that my parents had set up. And from that day, I remember like going through the Morningstar reports and really trying to look at the full variety of options that USAA offered. And I was like, okay, these are the ones we're going to pick. At that moment, I caught the bug, right? And I was really fortunate that my parents gave me that exposure. I think when I turned 18, literally when I turned 18, I got my first individual brokerage account. Actually at the time it was Trade King, which is now Ally Invest through an acquisition. And I started sort of my individual self-directed investing life then. I think that's carried through to the work I do today. And it's been sort of even when I was in the service, I was always an active self-directed investor and always kept up with the markets. And I sort of knew forever that this was the thing I wanted to do. So again, I was lucky that my parents gave me that exposure as early as they did. And I think that's something that we try to build a little bit of public, right? I think as we deal with a lot of, our population, our membership skews, not the youngest, but definitely on the younger end. We do take pride in being able to, help people get up that learning curve.
Yeah, and it's a great question. I should ask that to the FinTech Power Hour guest. What was their first exposure to the markets? You're probably too younger to remember this, but my brother and dad would watch the like a public access Paul something. He'd go over the stock market on a blue screen with the tickers on the bottom. I'd be so bored of it during dinner, and that was my first exposure of the stock market. It was, we all have our different exposures. So then going to, the industry, I feel like some people jump into this industry and don't know what they're doing, in the sense of like the SEC. They should know what they're doing, but they make PFOF, payment for order flow, a big rallying cry, when in actuality, there's so many other things I can think of that could come, higher than that in prioritization. What do you think about this PFOF? And if you want to explain it to the audience.
Yeah, so payment for order flow, PFOF, PFOF, that it's basically the function of when a broker sends, the broker, you put your order in to buy a stock. Now the broker's got to figure out how to help you buy that stock, right? They've got to either send it to an exchange, send it to an ATS, which is sort of like an exchange type thing, or send it directly to a market maker who will fill that trade, right? And the way that the sort of ecosystem has evolved is sort of those market makers, wholesalers, as they're called, tend to pay the broker for that order flow, and it goes sort of on a commitment to how much they'll send to an individual wholesaler, because the wholesalers, for a variety of reasons, like to execute those trades. And so it's a bit controversial, because I think what we've seen happen, and I think there's a fair amount of academic evidence for, is when a broker sends that order to a wholesaler and then the broker gets paid for the trade, the customer usually doesn't get the best price on average when they go that route, right? Versus trying to find the best execution at either sort of the exchange or the ATS route. Now it's actually kind of a muddy situation where there's quite a lot of noise in the data, and it's hard to figure out on any individual order for any individual broker what's going on. But in general, I think the logic would state, if there's a wholesaler that's willing to pay the broker for the order, just as easily, they're doing that for some economic reason, and that economic reason is so they can make money. And if they're making money, that's got to come from somewhere. And usually that means there's some value in the order that the customer could be getting in the form of a better price if they went an alternate means. And again, we've seen some data to say that in the past. And I think the SEC is actually doing quite a good job, at least in some of their proposed rules, at helping make that more transparent through better sort of execution quality, disclosure requirements. So every broker is going to have to report sort of what the sort of their statistics in terms of what pricing and what price quality they get for their orders. Now, I think saying out loud, hey, there are issues with our equity market structure and the way retail orders get executed. Absolutely true. We can always make that better. I still think we have the best capital markets, the best equity capital markets for retail investors in the world, but we can always make those better, right? Those are not incompatible statements. To your point, Jason, I do think there are plenty of other things where retail investors, where the negative issue or their bad issue, or sorry, there are issues in our sort of capital markets that probably impact retail investors more than payment for order flow. I think that's self-evidently true when we look at things like options trading, options market structure, the mutual fund, 401k, 403b businesses out there. Like those tend to have, I think, probably a larger negative dollar impact on retail investors than the pure equity market structure, which, like I said, absolutely the best in the world.
Yeah, I just like, people didn't understand how mutual funds work and fees. And when a mutual fund managing director sells, you're taxed, and they didn't understand that versus ETFs. But I don't see the SEC investing, like putting limits to make people understand that. And that affects your financials way more than I think payment for order flow does.
I think that's absolutely true. I think that sort of potential loss on the order, is on the order of a penny a share is sort of the max, sort of the max version I've ever seen anyone sort of claim that there could be as much as a penny of share in sort of trading loss from going with a payment for order flow route versus another. And in the grand scheme of things, relative to tax consequences, like you said, relative to like high ongoing management fees, fixed expenses that you find in some of these sort of employer sponsored plans, like there are bigger issues out there.
Yeah. And the other thing I was going to say, 1 cent. I remember when I sold Amazon in 2001 and I got charged 20% of the shares, so that, like, it's crazy to me, but that's just my take. Okay. Now we'll go to public. So public AI, what do you guys on the AI front? And there's something with your alpha tool, but can you walk us through what you guys are looking at for AI?
Yeah, so I think I said earlier, right? I think we've taken, we've made a lot of strides in building all the best possible content that we can into the app. Content meaning everything from like market data, pricing data, fundamental data, research, analysis, news, right? We want to pull as much of that information into the app as possible. And then what we've done is we've used sort of GPT-4 and the available, sort of the available LLMs, large language models, AIs, to sit as sort of a new UI UX on top of all of that information, right? So instead of having to go and scroll through the app, go to the Apple page and look through the news and so on, we've now used the GPT-4 to build Alpha, which is a chat-based interface for finding that same information, right? So you can go and chat with Alpha and say, hey, what's the latest quote for Apple? What was the price of Apple on X date? Hey, how did Apple compare to Tesla over the last 90 days? And it actually does quite a good job of answering a bunch of those questions that, some of them you could probably easily answer yourself going to sort of the Apple page and finding the right data. But many of them, as you start to get into multiple tasks or multiple data points, it does a much better job of summarizing and synthesizing that. So like, great example, earnings calls, right? So Apple had their earnings call last week. I didn't have time to go and listen to it. So I asked Alpha, hey, can you give me the summary of the earnings call? It gave me some interesting stuff. I asked how that compared to the past earnings calls, and it gave me, some really good information about exactly what was going on with Apple.
So Alpha is then searching earnings calls, data, all that kind of stuff.
Yep, it's got full access to basically everything that you can have that we have available to our users in the public app. We've given it to Alpha, and Alpha sits on top and just, again, is able to summarize, synthesize, and help answer those questions.
Did you guys create Alpha from scratch?
So we did. We created it fully from scratch, our own in-house team. Now the API stack is, pretty focused on sort of some open AI tools to include GPT-4. But yeah, everything other than sort of the GPT-4 models us.
How long did it take you guys to create Alpha?
I think we had the first version up and running in, I want to say 3 or 4 weeks. And then, it's really been a process of refinement since then. So, I think we started really having a functioning version in, April. I think we announced it in May. So it's been continuing to evolve. I think one of the things with it is like, no LLM, no sort of chat-based AI is perfect, and you have to. There's a massaging process of figuring out how to make sure when you ask it a question, it gives you back the most relevant answer, and a lot of that involves making sure it has access to the right data. But there's also a big part of it, which is giving it all of sort of the added context about the world that it may not have available in its data set, right? So like an interesting example is like GPT-4, if you just ask it directly via API, like what today's date is, it doesn't really know because it's only been trained back to like the end of 2021. And so one of the things you have to work on giving it is all of this, like what we call temporal information about like, hey, today is X. These are when we say this week, this is what we mean by this week. Yesterday was Y, right? We are in Q whatever, right? We are in 2023. Next year is 2024. We have to give it quite a lot of information about date and time. So when a user says, hey, how did Apple do last quarter? It knows that the customer is talking about Q2 23, not Q2 2021, right? And if it doesn't know that at the front, it can't go and find the right information in the data set. So there's a lot of that sort of massaging and iteration that we've got to do to really make it effective. And that's just an ongoing iteration process.
Got it. Okay. And is it something people are actively using now?
Yeah, we have quite a lot of people trying it out every day, and we've really seen a stabilization in sort of the active user base of it. And I think it's awesome, and it's just another way to sort of consume all the great content that public makes available, and we're absolutely seeing sort of the user base for Alpha grow.
That's awesome. And what was I going to say? Okay, so the next question I have is, what's something you wish every person knew about investing?
What is something I wish every person knew about investing?
It's a pretty broad question, but like what I would say is the majority of people still don't invest in the stock market. They're scared of it. They may invest through a 401k, but they're not, actively investing in the market like, they should, knowing there's returns over years. So the question's more geared to how to get people interested in the stock market.
Yeah, so I mean, I think the two things that I see for most people is one, they overestimate the people that aren't actively investing. I think let's focus on that group. I think they overestimate the risk involved in investing in the stock market. And I think what the caveats there are, with sufficient time and sufficient diversification, I think the risks are reasonable, and you get a healthy you're likely to get a healthy return for the risk you're taking, and that risk adjusted return that you get is probably more attractive than anything else you're going to find from an investment category, to include fixed income, to include real estate, and so on. Now, again, what does sufficient time and what does sufficient diversification mean? I think those are sort of in the eye of the beholder. I tend to be sort of a intellectually a very sort of modern portfolio theory passive investor type, while also on a daily basis doing things in my own portfolio that don't conform to those principles. But I think, again, focus on a really well diversified market weighted index of equities, holding them for 10 plus years, you're very, very, very likely to have a strong risk adjusted return. And I think most people assume that, like, if you make that sort of investment and you buy a equity index fund, I think most people assume that's much riskier than it actually is. And I think they assume that all of their capital is at risk, when we know historically max drawdowns are actually quite modest when you look at such a well-diversified portfolio.
Yeah, I mean, over time, you could look at any time in the market. Over a 30-year time, the S&P has averaged 10%. Now, having said that, I have a lot of money in T-bills and municipals, and I don't have most of my money in the market because I know I don't want the short-term fall off, and I'm not ready for my 10-year plan. But the right thing to do would be in the market and just leave it at that. But I diversified, and I have small amount in the market, but then T-bills, municipals, and real estate, I guess.
Yeah, and I think the hardest thing I see, people that I talk to about this every day, the hardest thing they struggle with is figuring out when they might need the money, right? And I think they actually tend to underestimate how much money they might need in the next 2 to 3 years. And then I think they also underestimate how much of their money really is 30 to 50-year money that they may never need, right? And I think that there's sort of this barbell problem where people are probably underallocated to short-term savings vehicles, right? And really, you want to optimize those on risk and rate of return. So things like treasuries that we offer on public, T-bills, really high quality. But then I think they also assume that all of their money, needs to be, they tend to actually be too conservative with the money that they actually may never need, right? And I think as you start to look at money that, hey, maybe this is sort of generational, even for somebody that's relatively young, this might end up being generational assets based on my own, specific personal interest. Like, actually, I should take more risk on that than I am right now.
That's where I'm at. What I'm saying to you is I have some money in T-bills and municipals, and we're going to get into your T-bills and alternative investments in a minute, but I have some money in T-bills, municipals, that is money I'll never need, arguably, and it's not in the market when it should be. I understand that it should be. It's
Yeah,
just,
you can. I mean, put it in the equities, and again, put a little leverage on that, right? If it truly is money you think you'll never need, right? Like, again, then I think that's I think a tough. It's tough to be allocated to anything but equities. And again, you can think about some of the more minor equities, asset classes like VC and private equity at that point, right? But I think when you're talking about truly intergenerational assets that have a time horizon of more than 30 years, one, the equity markets are great, but two, you can sort of plan that out over a longer period of time. And I try to tell people all the time to put a little leverage on it. Nobody ever does, but
that's
inefficient.
But that's what I was going to ask you. What do you mean put leverage on it? So let's just say I'm making up numbers, okay? Let's say there was $10 million that I had that I don't need for 50 years, okay? What do you mean by put leverage on it?
So I think
and I know leverage is debt.
Yeah,
I just don't know.
I think buying a broad-based index of global or U.S. equities, and buying 110% of that with your 100% of money, and again taking sort of secured borrowing costs against the sort of, like you said, whatever your appreciation assumption is. If you can borrow at 7% right now, whatever that is, and you think your long-term returns are going to be closer to 10%, right? By putting a little bit of leverage on there, you're gonna ultimately see better long-term investment returns. And these are strategies and products that exist for the high net worth, ultra high net worth. Their bankers will set them up in the form of structured notes and so on. But those aren't sort of retail accessible products for the most part. Kind of hard to do that in a margin account. And the thing you have to worry about, and again, why I said, hey, 10%, 20%, et cetera, is you got to be conscious of not blowing up your account, right? You don't want to get out to a point where your max drawdown is going to put you into a margin call or a capital call.
Well, that's where I was going. So let's go with that logic of the 10% of your money into that whatever and put leverage on that. The other 90% of your money is earning 5%. So now you're putting leverage on the 10%. You're taking at a 7% rate. So your money's costing you more than what you're yielding in your like T-bills.
Yeah, but I'm saying for that tranche of money, I wouldn't put, I wouldn't be holding any allocation in T-bills for 30-year money.
Yeah, so with that tranche of money, and then your point is the market could draw down 10%, but over 30 years, you're going to be ahead.
Yes.
Yeah, that makes a lot of sense. I mean, that makes a lot of sense.
A bunch of variables. Hey, what's your secured borrowing cost going to be? I think it's a big one, right? How much, what do you really believe about the long-term sort of, average return in sort of the global or U.S. equity markets? How diversified do you feel you are? I mean, again, there are a lot of considerations here, but I think as you think about really long-term money, I think, the evidence would say, historically at least, leverage would be a help.
Yeah, I mean, I'm buying the VU, but I definitely am not in the market like I should be. In terms, I buy some individual equities and have fun with that, but I'm indexes and yeah, you're right. And I don't get why over 15 years, over 30 years, the market always goes up. Is it just because more money is printed and that's what happens? I mean, if you look at any 30-year period, the market goes up like it's forever, but is that because one of my concerns is, and this will lead us to the alternative investments, the average person hasn't had that ability to invest in alternative investments, but through public and other vehicles now, the average person does. There's Yield Street, several others. You can invest in other assets. So then if the public can invest in other assets, then maybe the stock market's not the only game in town. So therefore, maybe it's not maybe the stock market doesn't follow the 30-year return like it has every, part of this decade or, century. What do you say to that?
One, I mean, I think predicting future market returns is tough, right? But I think what we've seen over the historically, you said, hey, why does the stock market keep going up? And the truth is, like, I think it's actually kind of over the long run, it's kind of rational. Again, I think corporate earnings are, genuinely corporate earnings are driving sort of the long-term returns, which is what you want to see if you believe that this is real and not a money printing thing. Now, again, if you want to say, hey, part of the reason corporate earnings are up is because of money printing, sure, fine. But I think, like, in terms of equity valuation, I think within a reasonable range, and we are in that range right now, I think we've seen sort of a rational increase in the value of the stock of American companies, right? I think that's what you got to believe in, is owning a large chunk or even a small chunk of really great companies. Those, you have to believe those companies are going to become more valuable over time based on what they can earn and the cash flow that they can generate, right? And I think, full stop, it's a real thing. And, again, assuming you believe in the American economy and so on, I think we'll continue to see some of those trends going forward. That being said, there are plenty of other asset classes where there's meaningful diversification to be had and uncorrelated returns. So in times when the equity markets, again, economy might be going through a recession, therefore equity markets may be down. We might see an earnings recession where earnings start to shrink quarter over quarter. In those times, there are plenty of other asset classes that have sort of, at least an uncorrelated, if not an inversely correlated reaction to those same sort of macro trends.
Yeah, part of me is like, the Fed just keep raising interest rates, don't fight the Fed. So now there's alternatives to invest in the stock market. So go invest in bonds, and don't put all your money in the stock market. That's part of my logic there. When the Fed stops raising rates, then go back in the markets. But to your point, 20, 30 years, you're pretty right on. Yeah. Okay, so now we're going to go.
For short term, right, we're really into fixed income these days, right? We launched our treasuries product, like I told you about, right?
But I think that's potentially going to improve soon too. The last person I had on the show was Bill Capuzzi, CEO of Apex. I think that's one of your backends. What do you say?
He's a good friend of mine. I love Bill.
Okay. Tell him, send him a text, say you're just on with me. And I think you guys have some new stuff coming out in terms of, I don't know if I even supposed to say. So maybe I will leave it out. But I think with alternatives, there's some new stuff that you guys have coming out. Is that correct?
Yeah, I mean, so I think there are a couple things. One, I think we're really focused on fixed income, right? I think we've launched the treasuries product, which basically is the easiest way for investors to get access to basically a 6-month average duration T-bills portfolio, right? That we're going to roll on and on, that's going to be rolled every 6 months, held to maturity. So you're going to, hey, if you see the 6-month T-bill is trading at 5.5% right now, you're going to hold it 6 months. You're going to get your 5.5%. It's going to roll at that point, right? Literally the simplest possible construction of a T-bill.
Wait. What do you mean it's going to roll?
So if you hold, so it's going to reinvest in whatever the prevailing 6-month T-bill is at the 6-month maturity. But the appealing part of that is, hey, if I know I've got, sort of savings or savings type assets that I think are short duration, I might need them in the next 6 months, 12 months, 2 years, 3 years, right? I mostly want to be focused on sort of maximizing risk-free yield now. And I think we know treasuries, for a variety of reasons, are going to be the best that you can get there, better than savings account, better than money market funds, et cetera. They've got tax advantages, right? You don't pay local or state income tax on your income from treasuries. So if you're in a high tax state, incredibly beneficial tax treatment. But you're going to get sort of the 5.5% headline yield, right? And you're going to get it, right? You're investing in an asset that's going to be held to maturity. It's not going to fluctuate on a daily basis because there's some portfolio manager in the background managing duration, moving stuff around, trading in and out, et cetera. You're buying a T-bill, you're holding it for 6 months, right? Simplest possible construction, and it makes a lot of sense. We've seen retail investors go crazy for it. It's been probably our best product this year, and definitely is driving the majority of flows of any asset class that we've got on public. But that's taught us further, hey, it's fixed income, right? It's not just treasuries. And so what I said earlier about retail investors starting to figure out the short duration, hey, if I need money in the next 1, 2, 3, 5 years, where should I be allocated? That's probably not equity market money because of the risk of drawdown. So, hey, where do we go? We want to go and look for sort of the maximum yield we can get out of a fixed income instrument, right? And again, you can decide where on that risk spectrum you want to go. Do you want to go treasury bills, no risk, or treasuries, or do you want to go sort of all the way out to high yield? And again, there are questions about credit quality and duration along that full spectrum, but we're really working hard on building access. Again, we did it with treasuries, building access into other categories of fixed income, municipal bonds, corporates, and sort of out the full spectrum, because I think we've seen a lot of, one, hunger for retail from retail investors for yield, and two, we think it's becoming a more attractive asset class that's better understood as we see prevailing interest rates rise.
Okay.
And again, we're working closely with Apex on that. Apex is also working on a variety of sort of alternative asset classes as well. But that's probably a little further off for us than fixed income.
Yep. Apex will be at our FinTech Deal Day. So in New York in November, we're doing a Future of Digital Assets event and a FinTech Deal Day. It was a crypto event, but then we switched to Future of Digital Assets. So November 13th and 14th, one day it's fintechdealday.com, and the next day it's Future of Digital Assets. It's going to be everyone in the trading space, to vendors, to banking, to every CEO. Check it out, FinTech Deal Day, if you're listening. But yeah, I mean, what I would say with Public, when I saw you come out that offering on T-bills, it was very impressive. You really can't buy T-bills in such an easy manner anywhere else. When I buy my T-bills, I have to do it over the phone at this point. And then they expire. I'm like, okay, how much interest did I make? How this? It's a little bit confusing. It's not set up to be easy. Or better yet, corporate bonds. Sometimes there's corporate bonds. And what would I want to see? Okay, I want to buy corporate bonds, but I want to see, what is the smart money doing? It's like, you look at the whales who are buying stocks. So I want to know the whales who are buying bonds so I can, copy onto those ones. Or what are the municipals doing where you can have a low interest rate low taxes if you're in Michigan and, it's tax-free or what have you. Well, how do you figure that stuff out? That is powerful, and it's stuff that Public's doing. So Public, yeah. You're not just for the brand new investor that's learning stuff. In essence, what I would say is, when I started Benzinga because I thought it was unfair that Wall Street had an advantage over Main Street in terms of getting information where Wall Street got ahead of it, and that's why I started Benzinga. You're doing a lot of the things where, when it comes to execution and being able to trade products that hedge funds only once could do.
Yeah, again, we want to just enable retail investors to get the access to the full set of assets that they could possibly construct their long-term portfolio out of, right? And again, I think that's it. I think we're working our way through, we've started with equities, including ETFs, added crypto, added some alternatives, adding fixed income, and you'll see us continue down that spectrum until we have the full breadth of sort of all of the asset classes that retail investors in the US could want. And again, we want to make them as easy to access as possible, right? Mobile first, as we talked about earlier, and two, make sure they have all of the content and information that they need to make informed decisions about each of those potential investments they could make.
A couple more questions. So you guys do work well on mobile. How about on desktop?
We do. We were obviously mobile first for the first 3 years of the company's life, but about 6 months to a year ago, we launched our the web app, where people can sort of access their portfolio and perform all the same functions on the web app. Now, that being said, the web app is a newer product for us, so still some work to be done, and we're still iterating there daily, but absolutely working on getting to complete parity on the web app, and it works really nicely, and it's a form factor we're continuing to invest in.
Okay, 2 more questions. Tell me about Pulse and Public and working with public companies.
Yeah, so Pulse is our sort of issuer services business. And so when public companies come to us and say, hey, we're really interested in retail investors, we're not used to communicating with them directly, right? They're investor relations teams. Every public company has an investor relations team whose job it is to tell the story of why investors should invest in that company. Now, they mostly spend their lives focused on institutional investors, right? So big mutual fund complexes, asset managers, hedge funds, endowments, that sort of stuff. But increasingly, they're becoming more and more interested in retail investors because they see the benefits of having a long-term oriented retail investor shareholder group. And so they come to Public often, and they have for many years. And we figured, hey, if we're going to get all of these, companies that are really interested in, talking to us about how to interact with retail investors, we should build a product out of it. So we built Pulse, and what Pulse does is it again does exactly that. It helps public companies, public issuers better understand and interact with retail investors. So we do products like town halls, where we're able to get sort of public company CEOs and management team leaders come in, do a little bit of a Q&A with our membership, and really open up sort of that dialogue between public companies and their retail, and retail investors more broadly. And that creates just really awesome content. And again, that's a great example, but there are a variety of other sort of ways that we work together. But it's all sort of a mutual benefit between our investors getting access to better information and the public companies learning more about how to appeal to retail investors.
Got it. So that's what you're ultimately trying to do. Okay, now I don't know if we left stuff out in public. There's a lot more. You can check out the app. You can, go to the website. You could hopefully see them at our Fintech Deal Day. Is there anything else that you wanted to say about public before we go?
No. I mean, I think we've hit a bunch of the high points, right? I think the big stuff for us that we're working on actively, again, I think fixed income, treasury is really important. Again, hopefully corporate bonds, especially now that things like Microsoft and Johnson & Johnson have a better credit rating than the U.S. government. I think we want to make sure that retail investors have access to that. So I think those are the sorts of things that we're working on. I think would love for people to come and give Alpha a try and let us know what they think. But I think those are the priorities for us right now.
Yeah, maybe I got to get Alpha on Benzinga and let people see it that way too.
Totally.
Yeah, if there's a way to do that. And then, okay, here's the final question: your first or worst job, or both answers? What was your first or worst job?
Let's do first job because it's funny. I don't think I've had a bad job in my life. But my first job was as a waiter at Cracker Barrel.
Right? Oh, wow.
Yeah, and so I often say that was like the only real job I've ever held in my life, because it's hard work. It's hard work slinging eggs and breakfast to weary travelers all day.
How long did you do that for?
I did that for 2 years in high school.
2 years in high school. Did you get some good tips, or what was it like?
Yeah. I mean, I think the tips were what you would expect tips to be, but I learned the one, how challenging a job that is, spending a lot of time on your feet, and two, I got pulled back into the kitchen every once in a while and had to work the egg line and learn how to make some mean eggs and bacon, and that was fun too. So that started a little bit of a hobbyist cooking career. I
was gonna say, are you cooking for your family now then?
I am the chef in the family, that is for sure.
Okay, that's Cracker Barrel. Yeah. Did you buy the stock when you worked there?
I didn't. I should have though.
I mean, come on.
Big winner over the last 20 years.
Yeah, they had a good system. You find stuff with good systems and go deep on it, right?
Yeah,
I mean, so there you go. Well, okay, Steven Sikes, I appreciate you coming on the Raz Report, our FinTech Power. Hopefully we'll get to see you at FinTech Deal Day in New York in November. You guys check out Public. It's growing. It was a startup and a few years ago, and it's growing, has a lot of users, does a lot of great things, a lot of great tooling, a great team behind it. So if you haven't seen it, check it out. And if you have any questions, I'm sure you can get in touch with management. They'll answer. We appreciate you coming on. And when you have new things you want to announce, please come here. This podcast is distributed to like thousands of places, and we look forward to having you on again. So thank you for coming on.
Yep. Thanks for having me.